Now let's talk about Kenya and its rather infamous 2016 rate caps. They do continue to inflict quite a bit of damage on the wider economy. Now in its latest assessment of this country, the International Monetary Fund in fact had warned that these rate caps could cut growth by up to 2 percentage points in 2017 and 2018 too. The rate caps have added a sense of crisis triggered by last year's liquidation of one bank and the receivership of two others. Interbank lending volumes in fact have fallen by about a third, and large banks over here are extremely reluctant to lend to the smaller ones. Earlier on, I spoke to Anzetse Were, an economist, to better understand this crisis in the interbank market.
Of course, they're going to cut down on their own lending in terms of big banks, but they don't want to lend to the smaller banks that they know their client profile is high risk. And so I think they're using that interbank now phenomenon to manage another risk tool that they've had to create for themselves, in addition to additional fees and charges that previously didn't exist. So I'm not surprised by that at all, and it would be prudent to sort of in order to buffer and to ensure that their profit margins stay reasonable, they're going to do that, and they will go to the same thing of lending to government and corporates. And some of the businesses that I talked to, the larger ones, said, well, this interest rate cap had absolutely no effect on us because we were getting that rate anyway. So, they're going to tend towards that, I think.
Right. So what happens now? The rate clearly hasn't worked, at least based on all the data that we have. But we've got an election coming up in August.
That's right.
What are the odds that legislators will sit down in the last session and say, yeah, this didn't work out for us, let's kill it?
Well, I think the onus is on us to demand data and information. And for us as economists and whoever else is interested in the welfare of the economy to demonstrate the case against the interest rate cap. I think now that the elections are over, once they're done, that populist rhetoric won't be as powerful because people know they'll be sitting for another 5 years. So I think we'll have to wait till the elections are done. And then after that, with the new legislators in place, really push for a reversal of this cap.
I mean, isn't the fact that we usually kick out, what is the turnover rate in our legislature? About 50% plus in pretty much every election. Doesn't that pose a policy risk by itself? Because now, arguably, the legislators who approve this, 50% of them could go home and we're like, nah, not my problem.
Yeah. I mean, the interesting thing is that in some ways, this is a blessing for banks. The legislators don't know that they're making banks more efficient. Sort of the layoffs that we're seeing, which is sort of linked to automation of banking services, but also linked to this interest rate cap, mean that even when the cap is reversed, the level of jobs that are going to be absorbed back into the sector won't be nearly as many as those that were lost. So it's interesting that in the long term, I think they're going to help banks run more efficiently and more effectively. Although there's a short-term pain, the banks will still recover. As for the new legislators, I think it'll be really a case of trying to influence and guide their decision-making as a public.
Right. Doesn't this perhaps box in the central bank to a certain extent? Because on one hand, if they cut rates in the name of let's spur consumer lending, banks will tell them, guys, you're killing my margins. And on the other hand, these are the same banks who will come into the bond auction and say, look, if you're asking us to lend to you at 10% and yet that's not where the margin is, essentially to the consumer market, why should we do so?
Well, I think it's interesting because I think the Central Bank of Kenya is in an interesting position. I don't think they're going to push for cutting rates. I don't think they will, and their past decision indicated that they won't, because there's a lot of other stuff going on in the economy that's pushing up inflation.
The drought.
Yeah, precisely.
Yeah.
Those sorts of factors. So I think that's going to be fine. I think one of the other factors that we need to remember is that the elections also tends to come with a lot of money entering the economy in almost an artificial manner. And although sometimes that tends to sort itself out in the long term, it can have short-term effects that can be quite painful. So I think I generally agree with the CBK position that rates should remain stable. And I think, ultimately, they were also of the view that this wasn't the best idea as well. So,
okay, they might not cut rates, but when we're looking at the drought that might be as bad as 2011, because that was the description that the Drought Management Agency used in its January report. This, if nothing is done, this could be as bad as 2011.
absolutely.
When you're facing something that bad, so food prices spike, energy prices go up, and then at the same time, oil prices are going up.
That's right.
Will they have the luxury of holding the CBR 10%? Might they not perhaps have to raise it at some point?
Let's see how big this contraction due to the interest rate cap is. I think that's one of the biggest problems we're having. We don't know the magnitude of lending. You know, people still think we only have 20,000 mortgages in this country. That's clearly not the case, but no one's given us more recent data and information. And that's why I think the whole data question is not surprising that we don't know enough, but I think we should use this opportunity as Kenyans to say, well, you guys need to get your data collection on point so that we can actually make some sort of analytical choices based on the information that we have. So I do think that the contraction is buffering a lot of this inflationary pressure we're seeing.